Welcome back to Smart Stock Sam. And if you've been watching this channel, you already know what I'm about to say. We called it. ONDS hit our exact price target. The bounce happened right where we said it would. And now the bigger question everyone is asking is this the top, or are we just getting started? Today, we're breaking down exactly where Ondas Holdings is headed next, what the real price targets look like going forward, and whether this stock still has room to run to $18 and beyond. Stick with me, because by the end of this video, you're going to see a setup that most people on Wall Street haven't fully priced in yet. Back on February 13th, I laid out a high-stakes thesis on Ondas Holdings, ticker ONDS. I said the demand zone was sitting between $8.70 and $9 even. I said that was the low-risk entry. Fast forward to February 17th, and the market gave us an intraday low of $8.87. It literally tapped our zone and exploded. Not only did price magnetize toward the $10 level exactly as I predicted, it closed at $10.05. That's a nearly 8% gain in a single session. When the math and the charts shake hands like that, you pay attention. Now here's what's wild. Could that level have broken down? Absolutely. Markets can always surprise you, but it didn't. And here's why that matters. What we're seeing right now is a rare triple threat convergence. The technicals hit our demand floor with sniper-like precision. The fundamentals just made a massive structural shift. And the market mechanics, specifically the short squeeze setup, are more primed than ever. Let me walk you through each one. Let's start with the technical picture, because this chart is a textbook move. For 3 straight weeks, ONDS was getting sold off, shaking out every weak hand in the room. But look at how the price action respected that demand floor. When aggressive buying volume took over on the 17th, it wasn't retail FOMO. It was calculated. Big money was parked exactly where we said they'd be, and when the catalyst hit, they unleashed it. So what was the actual spark? Ondas just officially graduated from a niche player to what I'm calling a Kinetic Defense Powerhouse. We're talking about Centrix, their software-defined radar system, and the Iron Drone Raider. These aren't cool tech demos anymore. They are now part of standardized procurement for world-class organizations. The German state police confirmed their contract. A $30 million plus demining award landed in Israel, and multi-million-dollar orders are flowing from NATO countries. This is the holy grail for any defense contractor, moving from one-off pilot tests to being a recurring line item inside a national defense budget. Once you're in, you're in. And if you want to know why Wall Street is suddenly waking up, look at the revenue picture. We are talking about a decade of growth compressed into just 2 years. Ondas is moving from a $16 million revenue base to a projected $180 million by 2026. That is nearly a 10 times increase. And it's not speculation. It's backed by a 180% backlog explosion. In finance, when your backlog grows faster than your current revenue, the catch-up phase for the stock price can be violent. We're standing right at the edge of that cliff. Here's the market they're dominating, the handheld counter-UAS segment, a $9.8 billion market over the next 5 years. With the launch of the Centrix Scout, Ondas is positioned to capture a significant piece of that pie through standardized deployments to police and military units globally. And right now, the market is pricing all of this at a discount. Could the whole drone defense sector cool off before this plays out? Sure. That's always a risk, but the structural tailwind here is about as powerful as any I've tracked on this channel. Now let's talk about what the actual professionals are saying. Stifel just reiterated their buy rating with a price target of $18. Northland Capital and Oppenheimer are both calling it an outperform at $16. When you average these out, you get a mean analyst target sitting around $18.38. Representing roughly 95% upside from where we are right now. When multiple analysts start moving targets simultaneously, it creates a valuation floor. It becomes very hard for the stock to stay suppressed for long. But here's the part that really changes the risk-reward equation: the smart money flow. We tracked institutional accumulation in 2 distinct phases. Phase 1 saw Vanguard and Goldman Sachs take significant positions. But phase 2 is what really caught my attention. On the February 17th dip, while retail traders were panicking and selling, Millennium Management increased their position by a staggering 161%. Citadel Advisors, one of the most sophisticated trading firms on the planet, increased their share count by 40% and their call options by 29%. This institutional wall is exactly what prevented a breakdown below our demand zone. They were accumulating the dip that most people were too scared to buy. And their buying is setting a trap for the bears. Right now, short interest is sitting at over 25.6%. But here's the kicker. The put-call ratio is 0.22. That means for every single person betting this stock goes down, there are nearly 5 people betting it goes up. With a days-to-cover reading of 1.91, any additional positive news from NATO or Germany could force shorts into a rapid covering scramble. They become forced buyers. And forced buying is how you get a vertical move almost overnight. Could that squeeze scenario fail to materialize? It's possible. Squeezes don't always fire. But with these numbers, the pressure cooker is about as loaded as I've seen it. The options market is also giving us exact price magnets for the next move. We have a massive concentration of over 13,000 calls at the $10 strike. That was our launch pad, and it performed. But look at the next major cluster. Nearly 25,000 calls sitting at the $12.50 strike. That is the magnet. As price approaches $12.50, market makers who sold those calls are forced to hedge by buying the underlying stock. It becomes a self-fulfilling prophecy of higher prices. And momentum is on our side without being overextended. The RSI is currently sitting at 62.72, warm but not hot. We've got plenty of room before hitting overbought territory. Meanwhile, the MACD just confirmed a clean bullish crossover, signaling that this trend is not a fluke. It's the beginning of a larger expansion phase. Before I give you my trade setup analysis, I do need to share an important reminder. Everything you hear on Smart Stock Sam is for educational and informational purposes only. Nothing in this video is financial advice. I am not a licensed financial advisor. Always do your own research and consult with a qualified professional before making any investment decisions. Markets involve real risk, and you can lose money. Past accuracy does not guarantee future results. So here's my analysis on trade setup for the week ahead. The new entry and reload zone is between $9.50 and $9.85. Watch the 20-day moving average support at $9.31. We need that to hold. On the upside, immediate resistance sits at $10.32. If we clear $10.45, that's the pivot that opens the door to the higher digits. Clean risk-reward, defined levels, no guesswork. And once we break that pivot, the long-term path opens up dramatically. The next major structural hurdle is the 200-day moving average at $11.55. I'm calling that the breakout trigger. Clear that. And there is very little resistance between us and the 52-week high at $15.28. And beyond that, the analyst mean target of $18.37 comes into clear view. With that said, the verdict on ONDS remains a strong conviction setup. We were vindicated on the 870 demand zone, the short squeeze fuel is higher than it's been all year, and the revenue trajectory is as compelling as anything I've covered on this channel. This is a fundamental pivot that the broader market hasn't fully priced in yet. If you found this analysis valuable, smash that like button, subscribe to Smart Stock Sam, and drop your thoughts on ONDS in the comments below. I want to know where you think this goes from here. Watch those reload zones, stay disciplined, and as always, do your own due diligence. The data is speaking. I'll see you in the next one.